Hello there. Welcome to Third Thursday Lunch and a Divorce Lawyer. I'm attorney Peter Olson, Chicago Family Law Group. Thanks again for joining us. This month, I am excited to have Larry LoVetere. Is that a correct pronunciation, Larry?
LoVetere.
LoVetere. I was focused on that middle syllable, and then I screwed up the last syllable. Larry LoVetere. And am I quoting your title correctly, Larry? Vice President of Mortgage Lending at Guaranteed Rate Mortgage, correct?
Yes, correct.
What's a quick background, your history doing that? How long have you been in the mortgage business?
I've been in the industry for about 18 years now.
Okay.
And been with Guaranteed Rate for quite a while. Wonderful company, love it. And I'm not leaving. The only way they're getting rid of me is if I'm not leaving on my own. Wonderful company, and I hope to retire here. With these folks. Wonderful company.
They seem like they've really grown in the last decade. I mean, I feel like
without question,
15 to 20 years ago. I mean, really, for 10 to 15 years, I've only done family law, divorce and child custody cases. But maybe the first 5 years of being an attorney, I was doing a lot of real estate. And I don't remember them being that prominent, but now they seem like a huge player in the Chicago market, if not national. I don't even know.
Yeah, in the last decade, there's been explosive growth. The company started in the 90s, and but within the last several years now, we just skyrocketed. We are now the third largest lender in the country, and
oh goodness,
they've really grown nationwide. It's been phenomenal, and but they have a great platform. The company does a great job in making sure that the customer has a fantastic experience, and so obviously not only is that good for the client and they refer friends and family, but it's also great for the referral partners who sent us those clients, folks like yourself, attorneys, realtors, financial planners, so they can see, the experience that the client had, and they send another client. And for example, at this point now, coast to coast, we work with over 77,000 real estate agents.
Whoa.
And it's a lot of real estate agents who trust us with their livelihood. So, we did 76 billion with a B in lending last year. And that puts us in third place in terms of the largest lenders in the industry. So I'd like to think we're doing something right.
Yeah, no, that's a big number, and
it is.
So Larry, one of your certifications is something called a Certified Divorce Lending Professional that the Divorce Lending Association, I think, sponsors or puts out. Tell me about that certification.
So I call it, the designation is the CDLP.
Okay.
Divorce Lending Professional, and it's provided through the Divorce Lending Association. You have to complete a very intensive training program and then pass a 3-hour final exam in order to earn that certification. And then you have to complete ongoing training throughout each calendar year to maintain that certification. And it provides a really well-rounded background for someone who wants to focus and specialize in working with divorcing clients, which is what I wanted to do.
Mm-hmm.
And it's not just about lending guidelines, but there are a lot of things that could come into play that are offshoots of the financing process. There could be capital gains tax issues, title issues, trust issues. There's a number of things that could come into play. And I'm trying to recognize when there are potential, I call them landmines, when there are potential landmines ahead. And I tell people I'm not an attorney and I don't play one on TV, but I know enough to recognize that you may be stepping on a landmine, and I would really recommend that you speak with a family law attorney before we move forward, or check with your tax accountant or your financial planner. I hate to see it, have an unfortunate incident happen. So So that training is very comprehensive, and it puts me in a really good position to be an assist to you in helping you help your clients have a successful outcome as it relates to their real estate and financing goals. And I pursued it because over the years, I had a lot of folks that came to me that were going through a divorce, and they would share with me what other lenders were telling them, what some attorneys were telling them. And I started thinking, gosh, there's some bad advice being passed around here. I think there's a need for someone in the mortgage industry that specializes in this.
Mhm.
There are over 600,000 loan officers coast to coast in this country, and there are only a handful of us that have the CDLP certification.
You have any numbers with that association, or how long has the qualification been around, ballpark?
So good question. The Divorce Lending Association has been around now for almost 10 years.
Okay.
And it was actually founded by someone who used to work at Guaranteed Rate, oddly enough. She had focused on working with divorcing clients for almost 3 decades. She saw a need way back when. She was in the industry before I was.
Mm-hmm.
And she was actually in the same office as me, oddly enough. And she saw a need. And so she focused on working with divorcing clients, developed a ton of expertise and connections throughout the industry. And then at one point she decided, you know what, there's a need for more than just one person in the industry of
Sure.
600,000 that knows what they're doing as it relates to working with a divorcing client. So she decided to start the Divorce Lending Association and offer training and certification to others. And now she does not originate loans. She's not working in the mortgage industry. She trains loan officers full time.
Yeah.
And this is one of the few designations or certifications that's actually allowed by the licensing authority in the mortgage industry. For back in the day, there were different programs that you could go through and be a certified mortgage pro or certified this or certified that. And after the housing crisis of 2008, 2009,
Right.
the government passed a massive amount of legislation, on the real
Right.
estate industries. And one of the things they said is, unless we approve a certification, you are not to claim to be certified or a pro in anything.
Right.
So you used to be able to see, loan officers, and they had initials for this or initials for that, and all of that's been done away. This is one of the things that's okay, though. This is one of the things they signed off on and said, you know what, this is good.
That's interesting. Yeah, I mean, I like certain states lawyers, you can be like certified in different things. Illinois, you cannot have any certification or specialization.
Oh.
Interestingly, yeah, I'm familiar with I run into I don't even know the exact initials or title, but the financial planner designation for divorce. I run into that one semi-frequently. I think you are the first person I've run into with the certified divorce lending professional initials. So yeah, that's super interesting. Yeah, I was digging through the association's website a little bit before we jumped on this call. It's interesting stuff. And is there what would you say your percentage of kind of deals that are kind of divorce related you're doing? Any idea on those numbers?
It's a sizable percentage of the overall clientele that I work with in a given year, because of the background that I have and developing a reputation in this niche, if you want to call it that. You mentioned financial planners a minute ago. Yeah, their designation is Certified Divorce Financial Analyst, CDFA.
Right.
And so I work with a number of those folks, as well as family law attorneys. And so I'm kind of a go-to person when people have questions about various aspects of a client qualifying for a mortgage. And I also try to make it, I try to again, provide assistance to all the other divorce professionals. So I put out a lot of information each month that I think will be useful to them in their practice. And, people appreciate that it's not just about sending me a client. I'm trying to help them help their clients.
Yeah, I'll tell you, back when I was doing real estate deals as an attorney, just doing some closings and stuff, and a lot of closings. I was, some of those boom years, kind of like 03, 04, 05. I was doing a lot of real estate. I was kind of at more of a general practice working for somebody else. And yeah, it was like, hey, Peter, you can't schedule anything else on Fridays except, do your 5 real estate closings. But my memory of that era was, and it was this statement. And I think, I'm going to get to a bigger point. I remember one of the people I even worked for, one of my bosses, I always found that in real estate, particularly residential real estate deals, the clients or the customers, they didn't always necessarily know kind of like what good representation was as an attorney. And I think the same is kind of true in terms of what you're talking about. And then we'll really dig into this lending and specific to divorce lending. My point being is, it was pretty hard to not eventually get a deal closed as an attorney. But you as an attorney, if you were like and I thought I was a pretty good fastidious real estate closing attorney, the difference between this was a really good representation where you were being thorough, probably saving your client some money. And then this other person who, frankly, the deal was still closing, but you weren't doing stuff right. You weren't, doing the real estate taxes right. You weren't doing different things right that probably ultimately, probably didn't sink the deal, but it probably did cost your client, a few $1,000s. And I think a lot of clients couldn't discern the difference. And I think kind of the bridge to the issues we're going to talk about with how to lend, right, in a divorce context, isn't it a bit like that? Whereas, a deal probably gets done eventually, but there's a lot of nuance there that is a lot better if you kind of know what you're doing versus, generic mortgage broker, right?
Absolutely. And I've said that for years. As a consumer, it's got to be awfully difficult to determine who they want to align themselves with. I mentioned earlier, 600,000 loan officers in this country. How do you figure out who the good ones are? There's a lot of family law attorneys, lots of,
right.
Underneath the financial planning banner, you've got a lot of different segments there. You've got those that are more in line with selling stocks and investments, others that are fee only planners that will create financial plans for someone, but they're not pitching a stock or a bond, or there's a lot of different segments to the financial planning industry. And as a consumer, you sit back and look at it and say, gosh, I don't know who to pick,
Right.
because they all sound good and they've got expertise and education and that kind of thing. So yes, and so I certainly understand what you're saying as it relates. It's got to be tough from the consumer's perspective. And yes, the financing on a mortgage can potentially get closed, but it's all the little things along the way.
Right.
It could be different from one lender and one loan officer to another in terms of how well that process goes.
Hey, so could we go down a little bit of a hypothetical and really dig into maybe tips, and not tricks isn't the right word, tips and best practices, let's use that word, for, sort of somebody considering divorce, maybe they're in a divorce, post-divorce, kind of how to do some financing, and maybe just compare that a little bit to just your average, person, let's say a non-divorcing person who wants to grab a mortgage. So I'm, knock on wood, and more than knocking on wood, I actually work pretty hard at building a strong marriage with my spouse. But so, if, me and my spouse, we actually just sold a house and we're in a rental for a minute here, just as we figure out our next move. So we're a non-divorcing couple. What is that average? I'm just calling us an average couple.
Sure.
What do we need to do to get a mortgage? You know, kind of the simple Cliff Notes version. And then I want to kind of track down, how does that kind of look different as, you know, one might have sort of a divorce piece to it. So what is just kind of the average Peter Olson, boring, married man? He has some income. You know, what are kind of the numbers and the metrics I need to do to grab a mortgage? And then let's talk kind of a more divorce scenario.
Okay. So typically what I would do in a case like yours is, collect some basic information about what you do for a living and your income from that job. And then I would normally ask you to send me certain documentation, specifically pay stubs, bank statements, so that I can verify if we're talking about putting 20% down, let's say, just to pick a number, that we've actually got the funds on hand to do that. And then I'll typically ask for tax returns, and especially if someone is self-employed, because there's often a lot of write-offs and deductions that impact actually what the income is that's usable for mortgage qualification. So I'll collect all the basic documents up front and then build out numbers, determine the maximum price range that the borrower qualifies for. And I'll show them what the estimated monthly payment is. And I'll explain the different loan program options that they have available to them. And it could be conventional financing versus FHA. It could be maybe a 30-year term versus a 20-year term, those kinds of things. So that's a typical approach that we use with the typical client. And I haven't had a client that's approached me who was not actually working and wanted to get wanted to get mortgage financing. So the typical scenario is a person who's employed, either what we call a W-2 employee, working for an employer and receiving W-2 income, or they're self-employed and own their own business. But as it relates to a potential divorcing client, there can be some significant differences there. A very common scenario is a client will be referred to me who is going through a divorce and wants to refinance the marital home. It's been decided that one spouse or the other is going to keep the marital home, and they've been directed to refinance the mortgage.
Right.
And usually for a couple of purposes. One is to remove the other spouse from the title and the mortgage to that home, but then also often they're going to tap into the equity in the house. It's called cash out, and they're going to take money out of the house to compensate the other spouse for their portion of the equity in the home. So some of the challenges we run into is very often when the divorcing couple purchased that home, both spouses were working at the time, and we had two incomes to work with. What we often see now, though, is along the way, one of those spouses became a stay-at-home spouse and took care of the kids in the home. Right. And they quit working. And that's usually the person that's going to retain the house and wants to obtain the new mortgage. Right. So the challenge we have is they're not working. So now what do we do? So typically there'll be that person might be receiving maintenance and child support. And there are very specific lending guidelines that address when we can use that and how we can use those sources of income to qualify. So we have to really look very closely to make sure that those are actually usable sources. We may have to create distributions from retirement accounts to add to the income. If the divorcing client is employed, of course, and they've got W-2 income, or they're self-employed and own their own business, then we'll take the traditional approach and get the pay stubs and tax returns, and we'll use that income. They may also then, in addition to employment income, they may be receiving child support and maintenance. But often it's just child support and maintenance that we have to work with, and we have to figure out what we can do there. And we're going from, potentially two incomes when they originally purchased the home. Two incomes gives you typically more purchasing power and
Sure.
allows you to pursue a higher price range. Now we only have one income to work with, and we have to find a way for that person to qualify using one income for a price range that they originally qualified for using two incomes. So a
So
little
how
bit
do, one of the things, I've learned, I think of late, and, you'd helped me with a little, but I think even just getting ready to talk today. Yeah, how do you on the lender side look at, or I guess, is it, one of, the Fannie Mae, Freddie Mac crowd, how does child support and maintenance need to kind of look to me if now I'm going through my hypothetical divorce and I'm receiving child support? Isn't there some magic language like you need to be receiving it consistently and blah, blah, blah for 6 months? What's the language? Because I think that's actually really important in terms of how the divorce is structured, timing on things. What is that picture that I'm inartfully explaining there?
yes, and you're bringing up an excellent point, and that in itself could derail the borrower's hopes of qualifying for mortgage financing if things aren't structured correctly. So with child support and maintenance, within the lending industry, we have to be able to document that the borrower has been receiving those sources of income for a minimum of 6 months
Okay.
before we can use that income to help them qualify for a mortgage. We call it the 636 rule. So we have to show that they've been receiving it for at least 6 months. And then we have to be able to demonstrate that they'll be receiving it after post-closing, that they'll be receiving those sources of income for at least 36 months going forward.
Mm.
So what often happens is, one, the 6 month rule is a backbreaker. Very often, and I've seen it any number of times, a family law attorney will write the settlement agreement in such a way that they identify that the retaining spouse is going to refinance the mortgage, and they have 90 days in which to do so. And if they don't complete the refinance within 90 days, they have to put the house on the market and sell it.
Right.
Without regard for the fact that we're going to be using maintenance and child support to qualify, and we can't use that for 6 months. So we have to have the mortgage financing done in 90 days, but we don't have any income to work with for 6 months.
Right.
So
no, that's a great tip. I had historically done that, and I think that was, pretty standard practice until I've spoken to people like yourself and some other people.
yeah, 90 days was a very typical number in the settlement agreement. So you touched on something a minute ago. It's very important to have the right team of professionals as someone going through the divorce. Have people who on your team, I call it the divorce team, who know these nuances, and they can set up the divorce decree in such a manner that you can have a successful outcome as opposed to having an unfortunate outcome. So the 6 month issue is the first thing. And then the 36 months, if people don't do the math, they don't realize that, for example, specifically with child support, we have to be able to show that they're receiving it for at least 36 months post closing. And let's say that they have 3 children and their ages are 16, 17, and 18 years of age.
Right.
Most of the time, the spouse is only going to receive child support until the child turns 18 years old. So someone might write up the settlement agreement and say, okay, they're going to receive, just to pick a number, $300 a month per child. That sounds great on the surface. Okay, $900 a month in
Right.
child support. But when they go to apply for a mortgage, and I look at the divorce decree and I say, well, your children are 16, 17, and 18 years old. And if child support ends at 18, so the first one, we can't count the $300 for the 18-year-old. The
Right.
17-year-old will be 18 in a year, but I have to be able to show 3 years continuance. So
Right.
support for the 17-year-old, and the same thing with the 16-year-old. They'll be 18 in 2 years, and I need to show 36 months. So we actually have no child support that we can use to help the client qualify for mortgage financing. So while the intent in the divorce decree was good, okay, we've got child support coming in, and hopefully this child support will help in qualifying the client for a mortgage. Actually, none of that child support is usable in that particular circumstance.
Yeah.
Don't sit down
And
and do the math. They don't realize, it's not helping.
what are you functionally looking at to say, somebody has received 6 months of support? Like what does a lender want to see on that end? Like, I know from where I'm sitting, good proof of child support payments would be a payment history from the Illinois State Disbursement Unit. What are you wanting to see, though?
So we'll typically ask for bank statements.
Okay.
And you touched on a good point. And it's not just that the client received the payment, is that they received the payment when it was supposed to be received. So usually
Right.
in the settlement agreement, it will state specifically must pay on the 1st of the month or the 15th of the month or whatever it is. If the payment history is what we call inconsistent,
Right.
they got it on the 1st of the month, 1 month, they didn't get it till the end of the next month, they didn't get it at all for 1 month, that's inconsistent income. And so even though they're receiving the maintenance and it's coming in sporadically, it is potentially not usable for mortgage qualification. So we will use the bank statements, and we'll see a line item entry when that money went into their account.
Okay.
And then we can go further than that if we need to, but that's typically the document that we'll use.
I see. I'm just curious because yeah. Well, like when you have clients who are paying or receiving child support, there really are all different ways you see it done.
Yes.
We just finished up a case this morning, actually, right. It's talking to one of our more junior attorneys on, kind of what it looks like post case, right? We're going to send a garnishment to this guy's employer. And then our client will eventually get the money from a place called the Illinois State Disbursement Unit, which is kind of, goes from employer to Illinois State Disbursement Unit to our client, the receiver or the parent with the kids, basically. Tell me about, one other point I wouldn't mind talking about, Larry, if you had a minute, was
absolutely.
So if I'm doing that refinance, post-divorce, whatever, paying 50% of the equity of a home to my wife, what are the terms, or what am I grasping for? How can I make the terms of my refinance most favorable? Or isn't there some different terminology these days? Like a cash out refi or something else?
Yes.
I thought that's been kind of a moving target. Could you inform me a little on that?
Sure, absolutely. Also a very good question. And this is a mistake that I see made all the time. When a spouse is going to retain the marital home and they're going to refinance the mortgage and take cash out to pay off the spouse for their portion of the equity in the home, I would do that loan as what we call an equity buyout loan. And the reason that that's important is because an equity buyout can be done as what we call a rate and term refinance. A rate and term is just typically when someone wants to refinance their mortgage and lower their rate and their payment. A rate and term refi has very attractive, very aggressive interest rates. And with a rate and term refinance, you can access up to 95% of the value of the home. So just for easy math, let's say that the house is worth $100,000. The client can take out a new loan up to $95,000. So we can access almost all of any equity that's there in that home.
Right.
So an equity buyout allows you to do a rate and term refinance. Most loan officers in the industry will do this as a cash out refinance. Cash out refinance comes with interest rates about a half point higher than a rate and term refi would have. And you can't access as much equity in the home with a cash out refi as you can with a rate and term. With the cash out refi, you can only go to 80% of the value of the house. So on a $100,000 house, you can only take out a loan up to $80,000. The reason that's important is that may not be enough.
All right, sure.
To compensate the other spouse. And now we have to look at giving the other spouse other assets to make them whole, so to speak.
So the equity buyout loan is, I mean, I don't need the full explanation, but it's available to the divorcing spouse.
Yes.
Whereas I wanted to, redo 2 of my bathrooms and it's not available to me in that situation, correct?
No, if the purpose of your refinance and the reason for taking cash out is to remodel the home or pay off debt or pay for college tuition, that is truly a cash out refi.
Interesting.
The equity buyout is only allowed in the circumstance where a divorcing client is using it to refi and access equity to pay off the other spouse. Now, here's a key thing too. The equity buyout plan must be addressed in the settlement agreement. So
I see.
That I see all the time where family law attorneys, they're thinking along the lines of, okay, well, the client will do an equity buyout, but if they don't put it in writing in that document, an underwriter will not allow an equity buyout to be executed. It will revert to a cash out refi. So it's very important for the family law attorney to reference the equity buyout in the settlement agreement.
Huh. Yeah, that's good. Good stuff, Larry. The 636. I'd heard. Yeah, I think that's actually new information to me. The 636 specifically. I had learned and gone into that equity buyout loan. That had just been updated. Hadn't it just been updated with Fannie and Freddie, or did that? And what am I thinking about? I had a discussion with somebody earlier this year on that point, or earlier in 21. Let's put it that way.
There is with the equity buyout, Fannie Mae and Freddie Mac, which are the 2 agencies that write the guidelines, for conventional financing. Most people seem to think that they're pretty much the same. Well, they're not. Each of them have very unique guidelines. In some cases, they're very comparable and the same. And then there are a lot of other areas where the rules are different. So you do have to be careful and that's my job as a CDLP, is to know all the nuances and know which type of financing we're going to go with and which agency we're going to go with. We're a direct lender, so I can go directly to Fannie Mae or Freddie Mac, but I have to make sure that their guidelines match up with my client's scenario. So, and you mentioned, coming back to the 636, there's one other thing that I wanted to mention, and we're talking about that 6-month waiting period, having to document them having received that income. One of the things that can be done is that I call it starting the clock. We can start the clock on that 6 months if we get a temporary order from the judge stating that the other spouse is required to begin making payments for maintenance and child support. And so while the divorce may not be final, they may have already hammered out what those numbers are going to be. It's just the divorce just isn't final yet, and so the other spouse hasn't started making those payments yet. But if we can get an order from the judge for the other spouse to begin making those payments, we start the clock on that 6-month window.
That's interesting. Yeah, I mean, so temporary child support or maintenance, I mean, particularly child support if they're young children is pretty common, right? If a case is going to take a little while. If is that number, the temporary number and the permanent number need to be the same to start the clock, or what if it's a different number?
Good question. It used to be that, the number could be dramatically different. Now it really needs to be close.
I see, because temporary child support, very common. I would say what's also very common though in my seat is I feel like that number, the permanent number and the temporary number are often different. So I'll have to keep that in mind. See if I can thread that needle, because, well, I mean, if cases going on for a while, right, people's incomes have moved and this like that, and, now you're gonna, rejigger the numbers,
Yes.
something set probably, I would say ballpark 9 months prior. Unless somebody's in a job with a lot of movement on income, your income probably is going to move a little in a 9 month to a year period. So therefore, child support might move a little.
Yes.
So,
and I'm glad you brought that up, because it does have to be very close. Because from an underwriter's perspective, and this isn't just a guaranteed rate, this is industry wide. The underwriter's goal is to verify the consistency and stability and continuance of that income.
right.
So the numbers do need to be close.
Yeah.
In the past,
Okay.
there was more fluctuation, and you're right. That's kind of a fluid situation, as you mentioned. People's income can potentially change. They can change jobs before the divorce is final. Folks that are in commission-based industries, or they own their
Right.
businesses where income is not always a set number every month. So, but that is something that can be done, starting the clock, so we can arrive at that 6-month window sooner rather than later.
Yeah. No. Absolutely. No. Because on my end, who's as somebody, I want to wrap pretty quick here. I mean, I'm literally today, as we're talking, and literally kind of messing around with the terms of kind of like, are we going to sell a property in a divorce? Or are we going to refinance it? And we're literally trying to like do the final divorce prove up on Friday. So, you think about all this ability and, attempt to be proactive. And then, I got these clients wiggling around till the last minute. Thankfully, in this deal, all of what you just said isn't relevant for the most part, because nobody's getting child support or maintenance. But
That's good.
if they were, right, all of this
cleaner.
stuff would be like, it's like, my gosh. It really is sometimes very difficult to get a client pinned down on some of these things.
It
Where
can
you
be a
can
very
create
challenging
these,
situation.
where you can create these, that 6-month window, or that but
Or
Larry,
or setting up distributions from retirement accounts as an
Yeah.
additional income source that can be challenging. And so there it can, and then depending on the nature of the client, there could be a lot of assets and real estate that needs to be divided, and it could be very challenging for you as the family law attorney to try and be fair and equitable. And the assets are not all the same. I've seen situations where spouse A has 500,000 in their column, and spouse B has 500,000 in their column. But spouse B's are all taxable assets, whereas spouse A's are not. So is that
right?
a fair division of assets? So there's a lot of moving parts that, for you as a family law attorney, it can be very challenging.
Larry, thanks again for joining me. Tell me this, or tell the audience this. Who's kind of a typical person or client you're working with, and how can people reach you? How and where?
Yeah, I appreciate that. So I work with all sorts of different clients. self-employed, employed, different income levels, different walks of life. I'm there to help everybody. In fact, it's very interesting for me to meet, people from different backgrounds. So I work with all types of different folks, from high net worth to first time home buyers. And as far as reaching me, my cell number is 630-306-5060. My email address is Larry, LARRY, and then a period. And my last name, which is LoVetere, that's LO, V as in Victor, ETERE @rate.com. You can also find me on LinkedIn and Facebook as well.
Awesome. Well, thanks again for joining me, Larry, and I'll surely keep you in mind for our referrals. And yeah, super appreciative of, right. I mean, I'm always kind of like yearning for good like business partners, because right. I mean, whether it's a mortgage or kind of a divorce, I mean, it usually ain't a one-man band. I mean, right. I mean, I'm trying to be narrow and specialized in what I'm doing, and likewise with you, when I need expertise in the mortgage space, I'm not looking to right. I mean, it's a team, right? I mean, unless it's the simplest of cases that once in a while you run into, but the majority, it's like you need a few people, whether it be the lender, the financial planner, realtor, therapist. It's a team, or you're, I think, doing a disservice to your client usually.
Absolutely right. That divorce team, having the right people in your corner is so important. So that you have a successful outcome. I know that's, a successful outcome is kind of seems like a strange term when someone's going through a divorce, but you can accomplish the goals, outlined in the divorce decree with respect to retaining the home and other things. So having the right people in your corner is so important. And I want to thank you for having me on the podcast today. Really appreciate it.
No problem. All right. Thanks again, Larry. Be well. Take care.
Thank you. You too, Peter. Thank you again.